In this episode, we're diving into one of the most popular ways high-income professionals invest in real estate without being landlords: syndications.
If direct ownership or owning your own rentals feels too hands-on for you, this might be the perfect fit. Real estate syndications offer passive income and access to large deals without having to manage a single tenant.
So what's a syndication? It's a group investment where you, as a limited partner, invest capital in a real estate project run by a sponsor or general partner.
Think of it like this. The sponsor finds and manages the deal, you bring the capital, and together you share in the profits.
Common real estate syndications include apartment buildings, self-storage, or mobile home parks. Now let's score syndications using our Fastfire Investability score so you can see how they stack up to the stock market. Now if you're not familiar with our scoring system, watch this video right here so you can see how we use this scoring system to break down alternative investments like syndications, so you can understand not just the upside potential of these investments, but also the risks and how to access these investments.
Getting back to scoring syndications, let's start with return potential. Many syndications project around 12 to 18% annual returns when combining cash flow and equity growth. Some even project higher returns with value-add strategies. For example, we have had investment opportunities in hotel to apartment conversion projects. These are high return investments, around 18 to 25% annual returns. Now these are projections. Actual returns vary based on operator skill, market conditions, and deal structure. So in terms of a grade, we give it a B. Usually better than the stock market, but not as sky high as something like crypto or angel investing.
Next is risk profile. You're trusting someone else with your money, and you often can't exit early, so there's deal level risk and limited liquidity. If you pick the wrong operator or market, the downside can be significant. Your money's locked up for years. That moves it to a C on the risk scale.
And finally, accessibility. Most syndications require you to be an accredited investor and have 50 to 100K minimums. And unless you're well networked yourself or working with someone like us, these opportunities can be hard to find.
Now let's walk through an example investment so you can see these investments in action. Let's say you invest $100,000 in a 200-unit apartment syndication. The sponsor renovates the units, raises rents, and as a result, the property is worth a lot more. This allows the sponsor to refinance or get a new loan on the property based on the higher value in year 3, or they could sell the property. In terms of the return, assuming things go well, you receive quarterly distributions, and when the property sells or refinances, you should get your capital back along with a lump sum payment, which represents your profit. You did none of the work and got a solid return. Now we've helped hundreds of investors take this path. It's a great way to scale wealth if you pick the right team and deal.
Syndications are ideal for busy professionals with capital but no time, people who want real estate exposure without property management, or those who want higher returns than REITs without direct ownership headaches.
Just be ready to vet sponsors, understand deal structures, and commit your money for 3 to 7 years. Okay, to sum it up, here's how syndications score. We give the return potential a B, we give the risk profile a C, and we give accessibility a D.
Next time, we'll talk about REITs, a way to invest in real estate with even lower minimums and total liquidity.
If you want to join our email list so you can be notified about syndication opportunities, go to fastfirecapital.com/newsletter. Also, we'd appreciate it if you could like this video and subscribe to our channel, and we'll see you in the next video.